Hi, and welcome to 3 Minutes on Markets and Money. Talking about a little bit of a heady topic this morning, commitment of traders. Now, we do this about once a quarter just to take a look at what professional investors are doing, and hedgers in particular are doing with their money, because it tells us a lot about what's happening within the overall markets. The market's been running here lately because the Fed's been providing a lot of liquidity, and this has really pushed more and more professional investors into equities, reducing hedges, taking on more risk. Currently, the market is now pushing up towards the top end of a 3 standard deviation move. Now, to put that in perspective, that's 99.9% of all possible price movement is already kind of baked into the market. It's also at a 12% deviation from its long-term moving average. Historically, these type of extensions can't last very long, but this is kind of a sign of the exuberance that's in the market currently. Also, our technical indications are currently pushing one of the highest levels that we've seen really at just about any point in history going back to 1998. Again, these technical deviations and positioning deviations suggest that a market correction at some point in the next few weeks to the next month or so is very likely. And so taking some risk off the table makes a lot of sense. If we take a look also at the Volatility Index, this is also at a very extreme extension. Net short positioning on Volatility Index provides the fuel for a correction. So even though this is reduced a little bit over the course of the last month, we are still at very historically high levels on net short positions for the Volatility Index. Oil prices have been collapsing, very big drop here, and positioning, though, interestingly enough, still very high levels. Net long positioning oil prices also provide the fuel for a further collapse. If oil prices break below $50 a barrel, we could see low 40s very quickly as these net long positions get unwound. Lastly, taking a look at the dollar positioning. The dollar's been rallying here lately as money's been coming out of China and Europe and the global economy into the U.S. for safety because of the coronavirus. We've seen a pickup in long positions in the dollar, but pay attention very closely to what's happening with euro-dollar positioning. This is foreign banks positioning into U.S. dollars, one of the highest levels on record. Historically, when we see these net euro-dollar positionings reverse and become much weaker, in fact go negative, that's been during more corrective actions within the overall economy and market itself, money being extracted out of the U.S. And the same goes when we take a look at the 10-year interest rates as compared to the net dollar positionings. When these euro-dollar futures reverse, we typically see a further decline in rates. This would be indicative of a recessionary onset, etc. So pay attention to this. It does have a lot of impact relative to your portfolio in particular. This report, along with the rest of our reports, videos, podcasts, etc., all on our website at realinvestmentadvice.com. Go by there, read, and if you have questions, make sure and click the Ask a Question button. I answer those emails every single day. Happy to answer any question that you have to help you out with your investing in your portfolio. realinvestmentadvice.com. We'll see you next time.